Every commercial strategy is built on assumptions, as you all know. So, what customers will value, what they will pay, where we should manufacture, which supplies we can depend on, and how much margin we can protect. Those assumptions are necessary, but markets don't wait for our assumptions to catch up. And that's where things become interesting. Look at what's happening around us. India's electronics manufacturing sector has moved from roughly 1.9 lakh rupees, 1.9 lakh crore of rupees of production in 2014 to 15 to around 12 lakh crore rupees in 2024 to 25. Semiconductor manufacturing is now moving from policy ambition towards actual production. At the same time, India's infrastructure investment cycle is changing. So, in fact, as per Crystal Intelligence estimation, infrastructure spending could reach anything around 90 to 100 lakh crore rupees between FY26 and FY30, compared with 59 lakh crore rupees in the previous 5 years. So these trends are not just strategic or economic shifts. They can change revenue, they can change margin, working capital, capital intensity, and competitive advantage. And that is what makes today's topic interesting. A company can be growing, winning orders, and investing heavily, and still be building tomorrow's business on yesterday's assumption. So the question today isn't whether commercial assumptions are necessary. They are. The question is, when does an assumption that once created advantage start creating liability? We are going to explore that in three parts. First, we are going to look at the demand shift. What are customers no longer willing to pay for, and what does that tell us about the assumptions sellers have built around value? Second, we are going to talk about commercial models and procurement. If customers and supply chains are becoming more strategic, why are contracts, incentives, payment terms, and procurement practices still largely transactional? Third, the liability question. Which assumptions are becoming expensive? What signals tell us they are weakening? And where should the next source of commercial value come from? So we'll move from customer value to commercial mechanics to future value creation. That is how we have designed today's session. And I'm delighted to have with us Sanjay Srivastava, a strategic advisor and former CEO of Mahindra World City, who brings deep experience in industrial ecosystems, manufacturing growth, and strategic partnerships. And Vijay Sabarwal, former CEO and board advisor with extensive experience in product leadership, industrial scale-ups, cost leadership, capital investment, and sustainability. Sanjay and Vijay, welcome to 2020X Vision session. Let's start with something personal. So in one sentence, what is commercial assumption you personally believe 5 or 10 years ago that you no longer believe today? And at the same time, while you answer the question, you can also talk about yourself, where you have been focusing on currently. So Sanjay, let me start with you.
Okay, sure. A very warm welcome to all your viewer audience online, offline, across the globe. Thank you for having me. So, as we talked of after my significant years of leadership experience, now I'm primarily focusing to as a strategic advisor to help build the ecosystems and platforms for tomorrow. So, how do you really build scale high-tech manufacturing, deep tech, and engineering industrial ecosystem? And that's what I've been doing. So how do we really take Make in India and Made in Bharat to really for the world? And that's why this is something really important. One of the, as I mentioned in the intro when I reposted, I think this is the time when geopolitics, economics, and business, especially post-COVID, have really come together as a triangle. And all businesses have a three-way close interconnecting. So one key assumption which is really disrupted, and many of the nimble players have learned it, but many of the large MNCs are learning it the hard way, is that earlier assumption was you have to really focus on cost competitiveness and the lowest cost. And that's what a lot of North American and European companies did by actually moving en masse to China or other low cost producing works. But when the COVID happened and then the geopolitics happened and the supply chains started getting choked, that is when people have realized that it is not about economies of scale and the lowest cost production, but actually diversification is really your differentiation. So it has moved from cost being your differentiation to the diversification. Your ability, no matter what is your cost structure, if the products are not going to reach your end consumer markets, then your cost advantage doesn't mean. And that's why I think increasingly in the new world, a very key commercial consideration is that all-time availability, predictable movements of my goods and services available to all my customer markets as and when they need in a predictable way. So that's one fundamental assumption which has changed. I'll be happy to talk a bit more as we go ahead.
Thank you, Sanjay. Thank you so much. I agree. Some of the keywords that you have used that actually resonates with the cycle that we have seen, not only from the economy perspective but also business cycles. And yes, predictability and availability are the key factors that can help any companies today to survive in future. So let me now move to Vijay. Vijay has been part of some of the automotive and specialty chemicals industry. Vijay, what is your take in terms of the old assumptions that you don't see today?
Vishwendra, thanks for having me, and hello to all the people around the globe, and hello to Sanjay. What's important to understand, I have been in the industry for last 37 years. I think COVID and then, follow-up of the Ukraine and Russia war, actually they have significantly impacted the entire, thinking process as Sanjay was mentioning. So what we were used to, not even 5 to 10 years earlier, maybe much earlier also, doesn't stand anywhere no more. I mean, it's a question of uh, uh, every day or every tomorrow is going to be very unpredictable, right? 5 to 10 years ago, how I would service the customer, I would just say that I know I need to ensure to give a competitive pricing with, try to ensure the deliveries are in place and services are in place, and I'm going to get a fair share of customers' wallet, and that is going to be perpetuity, right? And I could never imagine, right, an event like COVID. Actually, when COVID started, it was more like, okay, a couple of months of lockdowns, and the life is going to go on. But that 12 to 18 months of lockdown all across, right? Actually, the world came to a standstill practically, and people were struggling. So how the supply chains needs to be redone, and how you can build in the if I would say safeties around it is still a question mark. I mean, there has been one COVID incident and it shook everyone. I mean, going forward, if there are few more of these COVIDs and wars and all that part, you wouldn't know which way to look for. So I think it's more like you need to be more of forward, just you need to be like a chess player, trying to create situations and try to create solutions around it. How you create situations and solutions, that's a big challenge for everyone to work around, but it needs to be done now. That's from my side, Vishwendra.
No, thank you, Vijay. And yes, COVID has actually tested waters, especially for various commercial assumptions. So many commercial assumptions have been questioned, the way we have seen during COVID, or during the tariff war, or the war which is currently going on about the oil. So these uncertainties that are rising due to these events um, would keep on defining market as we move forward. But yes, at the same time, we have to be also prepared. So what you said about the priorities that have been changing, and both of you actually talked about the uh, the changes that are also happening from customer perspective. So let me now move to the demand shift, and that's where we talk about the customer, uh, the shifts in the customer priorities. And as both of you have covered, so customer priorities have changed significantly over the last few years, and customers are asking harder questions about simplicity, speed, outcomes, and total economics. uh, Sanjay, if customers have genuinely say stop rewarding feature richness and customization, um, they are no longer paying for what companies have spent decades building. And especially when you have been associated with the real estate and semiconductor industry, at the same time manufacturing. So how do you see this playing out, especially the shift in the customer priorities? And what are those areas that actually make, or discourage a customer, or customer make walk away from what these organizations are offering?
Sure. In fact, that's a great question, Vish. And I think the fundamental shift which I see is it's not about customers don't value your contribution, but it is that customers expect a greater sensitivity and responsiveness to change in their end scenario. So when we are talking about this disruption, in turn, it is the customer, especially in B2B scenario, the product life cycle, the customer competitiveness, the ability to disrupt by challenges the current large established or leaders of yesterday and today has changed, and hence as a service provider, as a product provider, as a manufacturing partner, you need to adapt very quickly. So what I think the new expectation is that you will be as proactive as the customers are in anticipating what their end customers there. So I think the fundamental shift I see is you are not just a vendor or a supplier. You have to take a higher positioning that can you be the enabler of your customer's success. So the customers may be, we talked about the high tech, they may be precision engineering companies who may want to move up the value chain and want to get into the semiconductors. They may be high-end electronics companies who may want to get embedded into the defense production, PLIs, etc. So hence, if you are a provider to them, you have to be clear on how are their end markets playing, which will be their growth market, and do you have the necessary R&D and the product gamut to serve them. If you do that, then not just will you be more closely embedded, but you will also expand your market. So you have to now start thinking that you are a co-creator of your customer's offering. And if you do that, then I think your ability to have a significant market share, as well as your ability to also offer innovative products changes. So that means as a B2B service provider or a B2B industrial product offering, you have to have anticipation, you have to have an outside-in view of what is the end market changing. You have to look at what are the new market trends, your ability to invest proactively, significantly in R&D budgets, etc., to be ready for markets of tomorrow and co-create products are the top three things I think will be the new differentiator.
Okay, so if I may ask, how do you kind of identify, or what are those first signals that can tell you that customers' value are shifting, equations have changed? So if you could share some example from your experience, what, if any, such signals that you have noticed, which I actually, made the organization felt that there's now customer value shift which is happening, and now we need to kind of shift towards those priorities.
Sure. So let me give you a very common example, so a lot of people can relate. Typically, till before, say, logistics, warehouse, third-party logistics started, most of the companies were going to buy a one-time land and then on a 99-year lease or a freehold, and then they will construct their own factory or setup, and then they will offer solutions. So now that was also taking a lot of Capex tie-up. So now increasingly, I think first with the logistics warehouses companies, they came up, they're saying, we actually need ready-made sheds or well-defined built-to-suit products. In turn, it gives us flexibility to ramp up, ramp down. So now you saw that suddenly what was actually a Capex model, the infrastructure and the real estate companies moved into a OpEx model, because you offer everything, but I want it on demand. So what was earlier only being done by typically as a IT park, actually now it is being done for industrial park. And if you see how quick the change has been, today if you see in the last 3 years, the biggest and asset RE investment class, which is doing well. In fact, just today morning, there was a report from one of the IPC consultants. The biggest demand is actually moving into the warehousing and logistics space. And that in turn is actually now also coming. In fact, this is not just the private sector, even from a government perspective, if you see, just few months back, there was an announcement of a Bhavya industrial park, which is essentially flooded or industry factory on rent. And this is what has been there in Vietnam, Thailand, some of the other ASEAN countries, has been there in Jebel Ali and other places. So that demand is coming is because essentially you lower the entry barrier for companies to come in to succeed. And once you succeed, you can always have either a model to expand, or secondly, you can always have a put or a call option that at the end of 5 years or at the end of 10 years, if the companies do well, they can take that. So that's just an example which is just played out, and everyone can see and relate to it.
Yeah, thanks, Sanjay. I think that's an interesting point, and getting support from the government, especially at this stage, is certainly very much required. So let me also talk about when we about these offerings. What is the value on defense, the bundling part, and Vijay, since you have spent a lot of years with the specialty chemicals, and also to some extent to automotive industries, where the relationship actually increasingly moving beyond simply selling the product. We also see financing, service, long-term supply, and even joint development becoming part of the commercial relationship. So is bundling actually what customers want, one contract, one throat to choke, from that perspective, or is it a defensive move by sellers to lock in revenue and quietly, mass price increase inside a solution? So for buyers, who go this route, what should they insist on locking down contractually?
See,
So
Vishwendra,
Vijay,
this is at the end of the day, money is getting very precious day by day, right? And alongside with that, because there is so much of uncertainty going around, so everyone is trying to lock in whatever best they can on in their revenue model, right? From a seller standpoint, especially when it comes to high value capital investments and all, or equipment, right? They would want to create a long term revenue model from creating a moat around the customer, so that they can keep on getting their so-called monthly or yearly income plan, and then they can tie in through then once you got someone on a long-term part of it, right, then you have a fair amount of chance of increasing the revenues, or your margins through services, whatever you can provide through, right? From a buyer standpoint, I think it's a good thing to go through whenever, because capital is precious, so and you don't have to invest your capital upfront, right? And but what's important is like both sides, they have to be very clear what their final financial math is going to look at, right? Like if I have to look at this, what's called use and pay module for industrial equipment, right? If I have a project, or if I have a product line, right, which is highly scalable, and as I scale, I make more margins because of volume. I would certainly go in for this, what's called pay and use model, because I'm not investing my capital on fixed asset, but whereas I can use all my money is in working capital, so I could make it more efficient, right? Because I know the more I push, the more I use my working capital, it is going to yield more results as I expand my business. But then, at the end of the day, we would all have to make sure that, we tie our financials well. We understand what the end game is. And, from my side, if I'm a buyer, I would make sure that's a waterproof contract where, stage wise, year wise, as the years roll in, I know where my financials are standing. So there's no surprise coming in for me as a buyer. And similarly, I do it for a seller, as a seller also, right?
yeah,
Uh, what's happening in specialty chemical space? Lot of your customers are looking for, instead of giving discrete products, or standalone, they're looking for a system to be delivered to them, right? Why they're looking for a system that so that they don't have to spend their own management time, looking at various components and trying to integrate that into systems, right? I mean, they would want, if I as a if I'm a procurement head, I would want my team to spending time more in terms of getting more of new product development, developing products which are straightforward drop in, right? And then maybe looking at the entire aspect of how my vendor is handling their supply chain, right? Important aspect for all the industry is how their scope 3 look, because that's still a very black box. So I need
right.
to be, as a procurement person, I need to be spending more time understanding the scope 3, because eventually, my customer or my end customer is going to be looking at what I'm doing on sustainability, right?
Yeah,
Sustainability may not fetch me premium, but surely, I can create a differentiation for myself, So that is how, I mean, I'm just
so
viewing
funding,
how this
yeah,
bundling and how things can be worked around between the customer and their partners, so that there is more of a value addition which gets created by the effort which goes in,
yes. So
right?
bundling can
And
actually create more value. At the same time, it can also create a better prospect in terms of your margins, your flexibility in terms of managing any shocks that you may see due to the shifts that are taking place in the market.
That's correct.
Right.
Because now you're looking at each other's supply chain rather than a buyer and a seller relationship.
Correct. Yeah. So quickly, if I can, ask you a question, what can make a company miss demand? Especially when we are looking at there could be speed and simplicity. That sounds good. But when since you had an experience in running product strategy and industrial scale-ups, including Industry 4.0 and digital manufacturing, why do companies keep bundling or keep building what customers don't want to buy? So, sometimes these scenarios do happen because there's a fixed way of uh, production. There's a capex investment that is going in the way you are producing solutions, offers. So, what is that? Is it a capability constraint, or is it something else holding them back, or making them miss demand? What is your quick view around this? And then me
Vishwendra, this is,
before you share your
yeah.
response, I'm also requesting all the audience who's there on the session, do share your questions with us in the comment section. I'll be more than happy to take your questions and insights. If you feel like you have any insight, contra view, do chip in and do share your contra insights in the comment section. Sorry, go ahead, Vijay.
Yeah, Vishwendra, this question should be asked within the organization and within the board and all that part which is there. But no one asks this question, internally, right? Why? It's a very uncomfortable question, right? Simplistically to speak, it actually starts questioning the wisdom which has been created by in so many years and so many decades, right? I would be of the view that companies tend to, consider themselves to be specialists in the craft, right? And because over the years, they've pumped in enormous resources and commissioned, commissioning and, high management stakes are there. And so it is very clear, they think through that, we know the customer. And, the more prominent you are in the customer space, that is the kind of thinking process which sets in. So we know what the customer is, what the customer needs, and and internally to the comfort of people within the organization and all the stakeholders, it adds a fair amount of if I would say sense of predictability of business, and it makes everyone feel very secure. Right? It is the old Henry Ford saying that you can have any color of the car as long as it is black. So he was of the view that, customer just needs black colored cars and that's it. Because that's more in terms of their comfort level that, I'm going to churn out what's called my efficiencies and everything. So I know the customer needs black, so I'm going to make black. So that is how,
Yeah.
it falls in. Right. When you talked about Industry 4.0, I was looking at, last, I think 5 to 6 or 7 years, this Industry 4.0 has become very prominent thing across, people are looking at it. But this whole concept, of Industry 4.0 was actually commissioned by a company called G Digital and Predicts, like almost 11 years earlier, right? They got heavy into it. But as G, the big industrial complex, which says, right? They thought they knew all the solutions, right? I mean, they would create a monolithic system, which is proprietary software and the platforms, and this is how we are going to present to the customer. But I think they failed to realize that what customer is looking for, because something which is new, right, is more in terms of it is like lightweight, easy. They need not get tied up to a platform or a software. And eventually, what happened is like this business unit had to be dismantled.
Yeah.
So there is a lot of we try to approach all solutions from our lens, and it could lead to catastrophic failures, which this is a very live example that a company like G, with all its paraphernalia and technology and management and all, they and being pioneers in being pioneers in 11 years earlier in industry 4.0, right? The company they created had to
Mm.
finally be dismantled.
Yeah,
So,
that is true.
so the internal orthodoxies of, right, we know the right thing and we're going to do the right way and the customer is going to appreciate us, right?
Mm.
Is needs to be looked at, very differently.
Correct. Yeah. So, yeah, you touched upon a couple of points, especially in terms of the frameworks, the way companies have rolled out their thinking in terms of um, addressing these concerns, especially when we are looking from the perspective of shift in demand. There's another component which is the trade and sourcing, and where sourcing actually becomes a critical part of this entire commercial proposition. So from where you source, which location you source your raw material, or your inventory, so that actually matters a lot in terms of how you can bundle and offer it to your customers. And due to various geopolitical issues, or economical issues, we see a lot of shifts that are actually take shape there. So, like for instance, um, there's a recent trade impact that has actually disrupted some of the supply chain across the world. But let me ask Sanjay. So, Sanjay, since you uh, covered a couple of these industries, as part of your track, so how much has that already reshaped sourcing? Means there are some of these market shifts that are happening due to the geopolitical impact, and the emerging geopolitics and global economics. So how that is reshaping sourcing and manufacturing, especially when we also look at a location decision. So it's not only sourcing, but it's also those locations where you would like to focus on it from the manufacturing perspective. So is trade policy now a bigger variable in commercial strategy than it was 2 years ago? So how do you see that play, especially from the demand shift perspective?
Sure, Vish. So I think how we need to see, as I said in the opening comment, that now there's a very close triangle of geopolitics, economy, and business, and each of them have to feed off with each other. So, on your point on trade policy, I would say that trade policy is almost an output based on those three factors. So finally, the trade policy, like for example, a PLI, or like for example, the Press Note 3, and now some of the relaxations coming in for adjacent countries, investment. All of those trade policies are straight off coming from what is the national priority or a strategic priority, what is the industry or the value addition which I want to go in. And once I make that offering, how do I ensure the right incentive is there, which is from a business perspective, a combination of the push factor and the pull factor. So somewhere there's already an inherent demand. We have the pull factor. Somewhere I have to give an incentive to apply the accelerator. So with that as a background, I see two aspects. One, there are certain very good opportunities, and secondly, there are some challenges. From an opportunity perspective, as we talked of, so from this diversification, one key thing is, especially building on Vijay's point on Industry 4.0 and the AI-based physical factories which are coming in. Now, the the new offerings can actually be offered using technology as a base and with 3D printing, etc., for almost a fraction of the cost at the incumbent cost, and can be actually offered anywhere in the globe. So someone who's just making 100 component, the per unit cost may be almost the same as someone who makes a million component because of the new disruptive technologies available. Like, for example, a couple of very successful rocket launches which just happened and sort of worked in India, and one of those rocket launches actually was actually a complete 3D printed rocket launch phase. So that opportunity is there, hence you identify any of your component manufacturer, whether in India or any part of the globe. Today they can create a modular structure and give you the same cost structure with a much more faster turnaround time and customization as the traditional players. So that's the opportunity. Hence, we have to be open and look at where the best in class is available. It need not be you're not constrained. And that is also being enabled by the FTAs and the trade agreements you are signing. So you are reducing the friction for movement. If you have, so therefore, if the tariff rates go down, that even a small economic order quantity break even reduces. From a challenge perspective, I think increasingly what we are going to see is when you're building this supply chain, and they are the incumbent countries or the incumbent large players, there will be a pushback. And that's where I think it came to, you referred to the point where chokehold was happening. So let me give you two quick examples and how India is working on it. Now we have our electronics and mobile manufacturing is one of our great success stories. We are already in just the last 5-6 years, we have now the world's second largest mobile manufacturer. For someone like Apple, this is the home base now. 70% of the iPhones going to USA are actually manufactured there. In under 3 years, Tata Electronics export value has crossed what Foxconn was doing from India for 20 years. But next level is, right now, all of that was happening with a value addition of about 20 to 23%. But a large part of the components was being done. So now, as similarly in semiconductors, you have OSAT fabs which have come in at billions of dollars of investment. But now the next level of investment is that if you have to be truly independent, we have to ensure the components which are going inside this mobile or semiconductor, whether it is the chemicals, gases, the golden wires, the rare earth, they also have to be processed and done that. So you need to build that value chain. And that is the harder of the point. And that is, for example, now you have the new electronic component manufacturing system. And the fact that there is so much demand, original target was about 55,000 crore. I think we already have about 106 proposals of over 65,000 crores where companies want to go in. And the government is aligning it that now the incentive is directly linked to the degree of value addition. And now the new bar is actually 45 to 50%. And then you have certain incentives. Similarly, the second big challenge is EV, semiconductor, defense, all of them intrinsically use critical minerals and rare earth. And rare earth is not rare. The ability to process and own the processing is what is the difficult part. So that's where, like, China has 90% of the global capabilities, and some of the erstwhile companies like GM, etc., did 100% of that technology transfer 3 decades back. So that's where someone like India, in partnership, what I call it is India is building a new Indus route. We have Japan, Korea, and Australia on the east side, and we have North America, South America, and EU on the west side, along with Africa. And India is going to be in the center, where they are, one, ensuring a long-term supply of these materials to be available, And secondly, attracting the companies through a consortium of geopolitical and country push to ensure the processing capabilities come in. If the processing capabilities come in, then the component value addition, whether it's a battery storage, whether it is the electronic components, your capability to own and be predictable will increase. So that's how I see the opportunity and challenge.
Yeah, so of course there are both opportunities and challenges, and at the same time you have actually shared a couple of examples, and especially how the criticalness of the location um, is valued more by the in terms of your trade, manufacturing, or sourcing. Now let me move to the commercial models, and what kind of commercial models that we are seeing, what kind of resistance that we see on these commercial models. Many times it so happens that these models are being built, but then the models can change when revenue is recognized, and then the risk is shared between, say, procurement and commercial teams. Um, uh, but then there are various ways in which the organization try to address that through partnerships, recurring revenue, and outcome-based models. So let me ask Vijay. Vijay, since you spent, you have been managing PNL matrix in some of these organizations. Um, uh, what's the real barrier to change from the commercial model perspective? Is it a structural, cultural, or something more fundamental, like accounting systems designed for discrete transactions rather than fluid, future-oriented revenue? So, where do you see these resistances to the commercial models, and when organizations should be considering shifting their commercial models?
Vishwendra, I have always been, trying to reconcile between the procurement team and, and the finance team. Because procurement team, they would say that, this is how we are going, or if the sales team is putting, people who are handling money, and then you have the finance team on one side, right, who are doing the accounting part of it, right? What happens, overall, right? I think in currently the way we handle the P&L, right, and the balance sheet is more in terms of the events which have happened, right, and very structured and defined standards for what all accruals can go into P&L and balance sheet, right, and some of these innovative approach in terms of procurement or sales and all, right, they don't end up getting reflected in the P&L or balance sheets, right? So therefore, there is always if I would say, people would go back, people who are handling the commercials, right, go back exactly what they were doing earlier, right? Because these things are not getting recognized in the current system. So I think it is more of a redoing all our looking at the the various accounting standards, and sitting through that and trying to understand how these real value additions can be caught into the balance sheet or the P&L, right? And I'm not saying that we have to be very imaginative in our accounting processes, right, where the controls go haywire. But I think it's time these things are recognized, and due diligence is done, and changes are made to the way we look at how we do the accounting part of it. Because if these things are not going to be captured, then people would not know what handling the commercials as to how the current value is getting, and how the future values will keep on getting created, right?
Yes.
Because what's important is what you are doing currently is good, but in a completely dynamic world, and with so much of a if I would say uncertainties still being there, being in a turbulent flow, right? You need the right way of making attempts to capture the future from a commercial standpoint, and that needs to be reflected in the financials also, because at the
Yes.
end of the day, any business, right, the final, if I'd say, whatever is done, it reflects in financials, good or bad,
Hmm.
right?
That is true.
Financials is just a reporting part which is there. So it is important that this is recognized, and across companies, and between various, if I would say chartered accountancy companies, and the board, and statutory part which is there, then that this needs to be churned through, right? It is still in very, if I'd say, initial stages, but it needs to be recognized, it needs to be dealt through, right? And it is not to be put under the carpet, because then the future value additions or creating value in future, right,
Yeah.
will get stymied. So this
Yes.
needs to be
So you,
recognized
yeah.
across industry.
So commercial
That's how I would
model
look at it.
friction.
Yeah.
Yeah, I agree. So the friction in the commercial model, or the
I don't mind
way.
here.
Yes, Sanjay, you're saying something?
Yeah. Sorry. Yeah, I just put a quick point. I think what Vijay is saying is very important. So how I would put for your viewers is an audience is the most tangible way to realize it is that earlier the supply chain or procurement head or a function was possibly many of the CEOs or the board may not even know them. But the fundamental shift is today the supply chain and the procurement strategy is actually a boardroom conversation. So that's where the board is asking the board governance is asking that question because it's part of your business continuity. That's where the CEO is focusing. So maybe just to put it in a more extreme or dramatic manner, I think the supply chain head of the function has moved from being relegated to a basement or a back office to now straight sitting at the same table where the strategy discussion is happening. I think that is a fundamental shift.
Absolutely, yeah. That's a that's a recognition of the teams, especially in the commercial and procurement functions, who have been actually seen more like a cost center, now are getting that recognition. In fact, Sanjay, there was a comment earlier on one of the posts, and it was about the supply chain finance. Since you talked about that supply chain financing, so there has been, and this comment was from Sumit Gupta, who is the president of ORG Investment and Holdings. Um, and he highlighted that any material shift like commodity, metal price shocks, or tariffs can lead to significant disruption to the supply chain financing industry. So of course, the context is about the financing industry, who is actually been involved in the supply chain financing. But then there are certain guidelines. So one of the biggest issue is that the buyer's payment cycle and the supplier's cash cycle do not always match. So there's always a gap between the payment cycle and the cash cycle. And there has been certain regulations, draft guidelines that have been shared by RBI. But would these disruptions force the financing players to go back on drawing board? What is your opinion? I mean, how do you see the mismatch that actually happens between the buyer payment cycle and the supplier's cash cycle? How can that be resolved?
So I think this push and pull between how much I have to invest vis-a-vis when the cash flow will come in, yeah, especially cash flow from operations has always been an issue. And I think there may not be one single solution, but I think in a nutshell, if we really have to look at it, I'll go back to the fundamental point that the finance agencies or the financial institution doing this financing, they have to look in the similar light that the companies whom they are financing are their clients, and hence what is the challenge and how those companies need to ensure they are successful. The accordingly the financing structuring or the financing solutions have to be proactive. So if it
Yes.
means there is a mismatch and you need to design a new product which is beyond the traditional line of credit or bill discounting, then so be it. You have to design that, because whichever today, like for example, the banks have been disrupted by fintechs. The fintechs in turn are being disrupted by someone else. So whoever, if there is a mismatch, and that mismatch along with uncertainty, whether it's a combination, it may be a combination of insurance, predictable flow, maybe using a smart AI to look at the degree of certainty of cash flow to come in. You have whoever constructs the appropriate solution which serves it, that's where the business will flow in. So
Yeah.
you have to essentially the rules, if the rules are changing for your clients, then you also have to change your rules to be successful.
Absolutely, yes. So, the other lens on this is the procurement on credit a legitimate use of buyer leverage, or is it quietly transferring financing risk onto the weakest link in the supply chain? Right. So you covered some part from the fintech industry perspective and financial industry. It's a huge risk for them, especially when we're talking about supply chain financing. But then someone would be also benefiting, right? Someone would be also using it as a leverage. So what, Vijay, what is your thought? Do you see this as a leverage, buyer's leverage, or do you see that it can backfire a critical vendor, or it can squeeze on working capital, quietly starting to deteriorate your orders or deprioritize your orders? What is your view, Vijay?
Vishwendra, it is, yeah, I mean, I mean, for every business, right, long credit cycles are a boon, I mean, everyone wants long credit cycles so that, the working capital is minimal, or the working capital could be used, elsewhere fruitfully, right? Rather than giving money out to your vendors. But I think it's important that, there is a downside to it, because uh, at the end of the day, you need to get serviced by your vendors, right? And if you are moving your squeeze to the vendors, right, what options they would be left with, right? I mean, they would be left with the options of, uh, their supply chain may get disrupted, right? If their supply chain gets disrupted, it may, and most probably would, right, end up disrupting your supply chain. So you have to do a evaluation to see that, whether a long credit cycle or disruption to my supply chain, which is more detrimental to me,
Hmm.
right?
Hmm.
Because at the end of the day, right, and I have seen that, if you're dealing with vendors, and suddenly, a few of the vendors, they wouldn't say no, but they would tend to switch off, right? Wherever suddenly, you have exigencies with X vendor with whom you've been very aggressive in payment terms, when it comes to crux, you may not get the kind of service the vendor should be around, right? Then
Yes.
it's not a process partnership. It's more like, okay, you have, and you are trying to squeeze things out of people around. So I think there needs to be a very judicious mix of how you need to be doing, right? You need to make sure that your process, I mean, your vendor or a process partner is there to service you, right? Through the services and products, you create more value for your customer,
Hmm.
right? So
Is it
your
possible
value creation through, sorry.
if you could share an example of how you have seen in the in your previous life?
See,
Any example?
I've seen in in automotive industry, you have a tier two supplier or a tier three supplier, right?
Mm,
Tier three suppliers are like a very small, small and micro part industries which is there, right? Even they may be supplying you very insignificant child part, right? But that is important for your the final assembly to come in.
mm,
Now, those
mm,
kind of setups are very hand to mouth, right? I have
mm,
experienced that, a small setup which was like about, I think, some 20, 30 odd crores kind of a business, they suddenly lost credit lines from their bankers,
mm,
right? And unfortunately, we worked with our own credit lines, and suddenly this guy said that, oh, sorry, I cannot deliver.
mm.
So it's like a small child part, but going forward, the entire assembly has come to a standstill because some child parts are not around.
Yeah, yeah,
So
yes.
those are,
So
I
the
think,
damage.
yeah, I think that is what it is. I would sum up by saying, there's an old saying that which goes that squeeze a lemon for one lemonade, serve only, right? Don't
Yeah,
go beyond that, right? So,
correct. Yeah.
you should know how much I need to squeeze to get one lemonade out. That's it.
Mm. That's
Don't push it further.
yeah. There has to be certain guardrails which have to be there, especially when we are talking about procurement, right? So now let me move to the last segment, and I'm going to use some rapid fire questions. These are the liability questions. How assumptions can actually become very expensive as we move forward, as we continue with these commercial assumptions. And Sanjay, if you could name the assumptions you believe in aging fastest, whether that's cost leadership, you talked about cost leadership earlier, or product differentiation, or vertical integration, or market driven growth. So, what is that uh, assumption that is aging fastest?
You think economic order quantity or create scale at the lowest cost is definitely going out of the window.
Hmm. Okay. And you see how can the hybrid annuity model can reshape the sectors, especially when we are sharing capex risk between government and the developer, with payment tied to performance rather than simply handling all the asset.
Yeah, means hybrid annuity model is already working very extensively for roads and other infrastructure. You can come in. One of the things which is I just spoke about it a couple of days back is when you are making, as you talked of significant investments, like in last 6 years, we have gone from 2 lakh crores per year infra spent by government to now this year the budget is 12 lakh crores is when you're making these mega investments in roads, ports, highways, railways, then the most important aspect which comes in is how do you also ensure there's a predictable total cost of ownership for a good quality SLA and maintenance. So I think the models of tomorrow also have to ensure that there is a predictable cost of operating these mega infrastructure which we are investing
Yeah.
in at a, especially if you are attracting global companies. There has to be a minimum level of maintenance, and that's where somewhere if wherever there is a struggle, I think one innovative thing which is coming up is I just read last year that there is a that I think over the next 5 to 7 years, India will need to spend close to about 23, 24 trillion dollars to make its complete infra net zero. And as per current modeling, close to 6 to 7 trillion of that is still a funding gap. And that's why I think the government has changed the regulation And they are in fact asking private equity, sovereign wealth fund, and pension funds to look at coming in even at a greenfield stage instead of just taking over the hybrid annuity model. Because if they come in, then they will do a stricter due diligence of the DPR, they will do a stricter insurance of all the compliance in place, and the planning stage will become that much more stricter, maybe tougher, but in turn, the capital flows in, but their ability to maintain it is there. So that's a new model which is coming in.
Okay, that's interesting. Vijay, quickly, you talked about sustainability. You also talked about some supply chain resilience and product strategies. So, where do you see which one would you prefer? Because we also seeing this geopolitical fragmentation, supply chain resilience, digital transformation, and sustainability. They are colliding at the same time. And from an operational and ESG standpoint, do you see this, or which one would you prefer? Where companies should be focusing more? It should be the supply chain resilience, digital transformation, and sustainability. Has all these been talked together currently?
I think Shindra, I would be looking more in terms of digital transformation and sustainability, right? Which are the two factors which are going to dramatically change, and would create resilience in supply chain, right? Currently, because the entire global is now getting fragmented, different regions, different political alignment, everything which is around, right? Now, digital transformation and AI coming in, right? See, up till now, right, few years earlier, right, the globe was fluid, but it was a steady state flow. People could predict things around.
Yeah.
Today, last 5 to 8 years, like especially post COVID, it's a turbulent flow, right? Now, if you have a turbulent flow, it's always said that when the flow is turbulent, there's too much of turbidity in the system, there is foam in the system, so you can't look through it. So if you can't look through it, then I mean, what are you going to do about it? You need to do something about it, right? So that is where I think the whole digital transformation, AI, that part which comes in, right, where you try to create a predictability, right, with what if kind of a scenario, and you need to do it quickly,
Yes.
right? It
That
is
is.
right. I mean, that's right. I mean, I need to take a decision, right, quickly, right? I cannot rely on, lot of permutation and combinations and, long analysis and then, take a decision in a week's time or a month's time or a 6 months' time,
Yes.
right? So my decision making window has actually squeezed out, right? But then I still need to make a decision, right? Which I need to be very clear that it's going to give some amount of predictability of what I'm trying to achieve. I can't take a decision on randomness. So all
Right.
this, digital and
But this is.
AI and that part, right? It's going to cut out the so-called randomness and try to put some, structured way where I can work around to see what I need to be doing, right? So create a path for me,
Yes.
right?
So AI is
Now,
certainly an area which can, AI and digital transformation are certainly area where companies could get a leverage. But for AI also, it's a very early stage, especially when we are talking about the manufacturing industry
right,
or industrial
right,
industrials. So that will of course take its own time. But yes, at the same time, the organizations have to be also ready when they are actually onboarding digital transformation at their end. So there's, because AI actually survives on the data, the organizational data, and if the organizational data is not structured in a manner that AI workflows can be worked out, then it might have a broken workflows which could actually impact more. But yeah, well said, Vijay. Sanjay, quickly, since you talked about the board and the CEOs, so what is that commercial assumption would you tell a CEO or board to abandon today if they wanted to be competitive in 3 to 5 years? And what would you tell them to double down on instead?
So I think from what needs to be changed is that ability to be extremely agile and flexible. I think that is what is really required because things are changing so fast. And from a long term, what you have to stay true is be very clear. I think most of the board and the CEOs are pushing that you have to be your long-term direction, what you want to do and which space you are playing, you should be clear. So the long-term strategy, which is your directional strategy, you have to be clear, have a robust one. But in the short term, for operational and tactical part, you have to be very nimble and flexible to adapt both to disruptions as well as any new opportunistic things which come up. So stay true to your strategic direction, but be flexible and very nimble in the short term to do what it takes to succeed. So I would say almost like moving from place A to whatever is your 5-year destination. But on the way, you may have to, if there's a lot of traffic or there is a new missing link like Mumbai-Pune which has opened, you should be flexible enough to quickly move on and capture it and move fast.
Thank you, Sanjay. So let me try to connect the dots from here, from the conversation that we had today. And I don't think the answer is another generic commercial assumption audit. That's too easy and frankly too theoretical at this stage. But the more useful question is which assumption actually changed the economics of the business. So one is your commercial assumption pillars. What are the few assumptions your commercial model depends on? Customer value, pricing, demand, cost, supply, capital, competitive position. Two, commercial impact. If one changes, what actually moves? Revenue, margin, working capital, capacity, cash conversion, win rate, market access. Third, diagnostic. What signals tell you the assumption is weakening before the P&L confirms it? A customer behavior change, a pricing response, a supplier signal, a competitor move, a technology shift, a regulatory change. Fourth point, future value creation. If the assumption no longer holds, where does the next pool of value comes from? A new segment, a different commercial model, a new ecosystem position, a different asset model, a capability we don't have today. So the question isn't simply which assumptions are wrong. It is which assumptions create our current economics, which ones are under pressure, and where should we create the next source of value. So that's much more useful boardroom conversation that we had today, because commercial strategy isn't about defending yesterday's logic. It's all about knowing which logic will still create value tomorrow. And if today's conversation raises another question, how do we identify these commercial signals early enough to act on them? That's exactly what we are exploring on 24th of September. The masterclass is from Signals to Pursuits, Mastering AI for B2B Opportunity Intelligence. We'll look at how AI can help commercial teams identify signals, build context, research buying situations, qualify opportunities, and decide where sales teams should actually invest their time. Because most signals aren't necessarily the advantage, knowing which signals deserve commercial attention is. So Sanjay and Vijay, thank you so much for bringing your experience and perspective to today's conversation. And thank you to everyone who joined us live. And it will be good to have this conversation continued. In fact, we have our next 2020 Vision session on 17th September, and where we are talking about when does a good deal becomes a bad deal, where we'll explore B2B sales, commercial risk, and procurement, and the cost of winning the wrong business, because there's a commercial paradox we don't talk about enough. Not every deal worth winning is worth having. So sometimes the most expensive deal is the one you win. Until then, one thought to leave you with: markets rarely announce that an assumption has expired. They simply start charging you for it. So thank you so much for joining today's session, and thank you Vijay and Sanjay for sharing your insights. It was good to hear you and good to have you have in this session. So good night.